Thanks so much for staying with us. We stay giving you analysis on that monetary policy decision that was just announced. I'm joined by Issac Mashego from Nedbank on the line now. Thanks so much for your time on SABC News this afternoon. A cut was expected by most economists. Was that 50 basis point cut enough, though?
Well, I will say that we were expecting 100 basis points simply for the reason that we believe that the SAB must front load the interest rate cuts. I mean, we are in a crisis like no other, and at this stage, the likely full impact of the lockdown, for instance, and also the travel restrictions and restrictions on movement of goods globally, the full impact thereof is not yet known. And we are believing that maybe the SAB would sort of take a proactive stance, but 50 basis points is still enough for now. Remember that since the April cut, there hasn't been enough data flow. So there's very little to base the decision on. So 50 basis points is okay. And the question is whether is there room for more or not.
The governor spoke when he was answering questions and during his announcement of GDP expected to grow by 3.8% in 2021 and 2.9% in 2022. Given that we are seeing unprecedented cuts from the SAB in decades low, as well as the situation that we're in, is he being optimistic about the kind of growth that we can expect to see in South Africa?
Well, remember that we're coming from a very low base this year. I see that the SAB has revised its GDP to a contraction of 7.0% this year. And remember, at the time of the March meeting, they expected a contraction of 6.1%. This is pretty much in line with what we expect. And going into next year, depending on how the pandemic plays out, both locally and internationally, we do expect a rebound, but it's not going to be a full rebound. So 3.8 is a very reasonable expectation. And going into 2022, assuming that the pandemic will be under control, most of economic activity will be back to normal. 2.9 would really depend on, for instance, the revival of output activity in South Africa. And that, of course, will need a lot of stimulation, particularly by the fiscus. And on the policy front, we're going to have to implement those structural measures to expand output capacity in South Africa.
Okay. Isaac, so before this announcement, we'd seen about 225 basis point cuts since March. I know you've spoken about that 100 basis point cut that was expected. How much more room do we have for cuts? And is there a possibility of cutting too much?
Well, let me put it this way. By the time of the July meeting, which is like the third week of July, the SAB will have a bit more data. The initial impact of the lockdowns, for instance, and restrictions on global trade will be visible. We will know what they are. And at that time, depending on what the numbers will be telling us, the SAB could cut again if there's going to be, more scary numbers than we expect right now. But of course, the SAB is going to have to balance that with its inflation expectations. And looking at their numbers today, there's not too much of a difference in terms of what they expect in terms of inflation. It's going to come down, but not significantly compared to what they expected at the time of the last meeting. So this could be the last one. But if the numbers really do shock us, there'll be room for more cuts. Could there be a mistake in terms of cutting too much? What I've been pondering recently is this the new normal for interest rates? Is, for instance, the repo rate moving down on a structural basis due to the shock triggered by this pandemic? Most likely. But if there is a policy mistake in terms of too much cutting, remember that it can always be reversed. Mm-hmm. So it wouldn't really be a permanent damage.
Okay. Isaac, you've also spoken about this shock that comes and that we are experiencing at the moment. We know that when interest rates are cut, a lot of economists and analysts always say, it's more money in the hands of the consumers. Are consumers going to feel it in a significant way, this cut, considering the environment that we're operating in?
Well, what's going to count for the consumer is the reduction in incomes, or at least very low growth in incomes. Mm-hmm. Reductions in their incomes, in the sense that we're already getting anecdotal evidence of some businesses is compelling their workers to take some salary cuts, either on a permanent basis or temporary basis, and that will hit consumer spending hard in South Africa. And by the way, when it comes to inflation, that is likely to have a very significant deflationary effect, and it could result in, for instance, the inflation rate in South Africa being lower than we expect right now, and that would give the SAB more room to cut. So the interest rate cuts are helping, at least for those who are carrying some debts. They are getting some room, but we are very scared that the real impact could be on the side of incomes, those falling much faster than, for instance, the drop in interest rates.
Okay. We also saw coming out of that statement that resident investors have increased purchases of long-term bonds, helping to ease yields in recent days, but the yield curve remains exceptionally steep. What does that mean?
Basically, what we are seeing in markets, if I can put it in layman's terms, is that, in March, when there was that global risk event, across the globe, investors were selling out of emerging market assets. That's why we saw the rand falling sharply. But not only emerging market assets, they also sold out of equity markets in the industrialized economies, also bond markets in those economies. So it was a massive risk event. According to, for instance, the International Institute of Finance, almost 84 billion was withdrawn out of emerging markets in March. And that, of course, included South Africa. And actually, the withdrawals out of our market were some of the highest, compared to the likes of Brazil's and Turkey's. We've seen some return in April, but it's still very small numbers. So what is happening here is that global investors were expecting the situation to be really bad. That's why you're seeing, long-term interest rates being higher, which simply indicates that there is fear. There is uncertainty related to the long-term outlook of South African investors. We're basically saying that we don't want to be exposed to markets like South Africa's in the long term, so we are pulling out. The SAB cut short-term interest rates. That's why we saw, for instance, the short end of the curve coming down. And what the SAB has actually done also is getting into the bond market, accumulating government bonds in the secondary market. In over March and April, it accumulated about just over 12 billion. And that has sort of, eased the strains in the bond market, and it's helping to bring back that stability.
Mm-hmm. So when we speak about a post-COVID-19 South Africa, whenever that may be, the governor referred to policies that are very accommodative and relaxed lockdowns in many advanced economies, supporting this recovery of global financial markets. But he says when it comes to emerging markets, financing conditions remain very uncertain. Can we tell, without the data that you've spoken about earlier on, what's going to happen, say, in the next year when it comes to financing for South Africa?
Well, I will say to you, what you've got to remember is that when global investors get back to markets, start investing again in high-risk assets, they will probably move last into very high-risk or vulnerable markets like our own. So for us, it's going to be quite some time, before the pain is relieved. But we do hope that, with the pandemic being contained globally, we do hope that there will be a return by international investors to our markets because, we do need some of that funding. But what we're going to have to do locally is quite important. We're going to have to start addressing the issues that, by the way, we're already facing before COVID-19 came to our shores and also hit the rest of the world. So we're going to need to address government finances. We're going to need to address the state of SOEs in order to lift the economic growth rate in South Africa, in order to expand the potential growth rate, which, by the way, the Reserve Bank estimated only around 1% at the moment. So we need to invest in this economy. We need to improve the efficiency of the economy so that we can achieve a higher growth rate. And of course, that growth rate is going to have to be coupled with job creation, because that's our main socio-economic problem.
Issac Mashego, an economist from Nedbank, thanks so much for your time on SABC News this